What is the stock market? And it is also known as the equities market or the risk market. So what are the ways to profit from the stock market? In this video, we'd like to present to you a few different companies that could give you different amount of capital gains. So imagine a stock market is just like a shopping mall that has great businesses for you to own without even starting one yourself. The best part is that you get to see your wealth grow over time. Right? So it comprises a lot of different companies. In the US itself, it's about 7,500 companies listed. Right. So now let's say, for example, Facebook has about 1 billion outstanding shares, which means it is divided into 1 billion parts to be owned. So if you bought about 5,000 shares, then you would technically own about 0.0005% of the company. So which means you can always own a slice of success in this company. So how's money made in stocks? So we can either choose high capital gains or high dividends payout stocks. It depends on the risk appetite. Sure, there are stocks that offer moderate capital gains and moderate dividends payout at the same time. So it's always like a seesaw effect. So if we go for high growth company, or they would actually give us more or higher share appreciation, and they would give you less cash dividend or even no cash dividend because most of the profits made is used into expansion of the business, reinvested into the expansion or the innovation also as well. So, but if we go for businesses that pay high cash dividends, these companies are usually companies that has been around for more than 2 decades, and they are called they are very mature companies in their own respective industries. So companies like Johnson and Johnson, AT&T, or even McDonald's has been around for some time. They do offer increasing cash dividends per share almost consistently every year. All right. So now, how are dividends paid? So dividends are paid normally from the profits of the company, and this is decided by the management of the company and how much of the amount of dividends paid per share owned by the shareholders. So this is to keep the investors invested in the business and also to attract new investors also as well. So here's the simplest way to calculate dividends. Now the very first thing people when they actually look at the amount of dividend they can get from the company is that they look at the dividend yield, and this is often taken as a dividend per share divided by the share price. So here's how it goes. If we look at the example, let's say for example, this is paying about $5 US dollar per share, dividend per share, over 100 share price, $100 per share. So and it gives out about 5% dividend yield. So, but the thing is that there's a problem with this is that this is very often I see it as a face value, which means if the share price drops to 50 US dollar per share, then what happens is that the yield will appear more attractive to untrained investors. All right, to untrained investors. Now, what is more important right here is that whenever the yields appear very attractive, then we would always have to check on the company fundamentals, because if the company is not performing well, then the share price would drop. So if the share price drops and the dividends per share remains almost the same, then the dividend yields would appear more attractive to untrained investors. So this is where we always want to check the company fundamentals and verify it before we even buy into the company. So this is what we always call it a dividend trap. If the company is not doing well, then over time, what we can see is that even the dividends per share would be reduced over time. All right. So we'll look into that in a further detail. So now, normally, how the more transparent way to calculate dividend yields, and this is very often that you have done the fundamental research and you have made sure that the company is doing fundamentally well. So what we do is that we take the dividends per share Okay, and this is on annual basis, multiplied by the number of shares that you have bought over your initial invested capital. And let's say, for example, you have bought 1,000 shares, all right, that's using about 100,000 US dollar, and the dividends per share is about 5. So this is taking about 5,000 over 1,000, so you get about 5% of the dividend yield. And let's say the business is doing quite okay, and it is still, the business is still having a very strong cash flow over time. And let's say the management of the company decides to pay more dividends per share, about $7 dividend per share, and that would actually equate up to 7%. So this is the most simplest way that we can calculate dividends yield. Now, take for example, if a company that's not doing well, which means the fundamentals are actually, or the revenues are actually inconsistent or dropping, then what will happen is that the share price will drop. So once the share price drops, let's say for instance, in the year 2017, the share price is about 31 at the moment. Dividends per share is about 0.93 cents per share, and dividend yield is about 2.94. All right. So now what happens is that the next year the dividend per share is almost the same, but the share price drops almost by 40% from 31.6 drops to 17.5. And the yields look very more attractive at the time, so it's almost close to 5%. Then the share price drops even more, down to drops about 60 to 70%, and the dividends per share also drop more than 50%. But the dividend yield it still looks attractive, and this is what I call a dividend trap. And to verify this is that we have to look at the most basic fundamental, is that how the business is doing. So the most basic part is that we look at the sales, whether it's growing or not. So it is actually, in fact, most of the time it's very stagnant and it keeps dropping. So this is like a 10 years horizon we're looking at. And the cash flow is gradually reducing over time. So does the profits, and the net income is also dropping even into negative zone, about 17% right here. So you can see if the business is not doing well over a long period of time, the share price is also reflecting that fundamental over a long-term horizon. So we can say that this company GE is consistently decreasing in sales and profits. So fundamentals are reflected in share price in the long term. So when the share price drops, then it artificially reflects a very good or reflects an attractive dividend yield to untrained investors. So now here are the few companies that we look at to compare the dividends over the capital gains. And let's say for instance, this is what we can see in some of the platforms, the share platforms or the share screeners. So if you go for high dividend yield, like a company like AT&T, it's a telecommunication company. So it has 7.1% dividend yield compared to the its actually the industry. It is higher than most of the peers. And if we look at Johnson and Johnson, it's about 2.43%, which is considered quite fair. And but it's just slightly below its industry average. And Microsoft, which offers the least dividend, all right, this company offers the least dividend, about less than 1%, and it is also about the same as its compared against its peers. So, and this is all recorded as of 5th of June of year 2021. Now let's look at AT&T, the fundamentals characteristics. So what we can see here is that there's always a few percent growth, or 1 or 2% growth over some years, and maybe have some slight growth also as well after some years. Then it becomes stagnant. So these are companies that has already matured, and they have a very consistent cash flow in red color line right here. So so there's only a few percent growth each year, so cash flow remains very stable. And this is also why they could retain investors by paying out some dividends. And what you can see here is that there's a way to actually look at how the dividends has been increased over the years. So the green color line is the dividends per share, and the black color line, or the black color area, shaded black color area, it's the dividends yield. So what you can see here is that if a company is always generous, then you can see the dividends per share is always increasing. But what is happening here is that if you bought this business even right around here at this area, which is around $26 per share, but after maybe more than a decade, you would end up maybe a few percent of the capital growth. So this is more of a very high dividend yield company rather than a high capital gain company. So now let's look at some of the dividend versus capital gains tabulation right here. So we take an example from the year 2010 to 2020, about 10 years horizon right here. So let's say if we have bought into the company in 2011, so and then we calculate the gains up to 2020. So you can see that the capital gains is not a lot. It's even negative 3.2%. If you just compare the starting January of 2011 against 2020 December close. So the total capital gains, let's say if you have invested 100,000, then you would have ended up with 96%, sorry, not 96%, 96,000 of your capital. All right, but if you look at the dividends per share has been increasing over time. And if you multiply that with your initial capital, so every year you can see that the capital every year the dividends has been increasing in the capital, and the actual dividend use versus initial capital has been gaining now from 5.8 to almost about 7% gain. So from there, what is the payout like? So if you actually sum all this together, you get about 63,000 over a period of 10 years, which means if you actually add this together, if you add this together, then you will actually get a total gain of about 159,000, okay, which is actually a 59,000 gains, and that totals up to about 60% gains over 10 years. But this is considering that you have not reinvested the dividends to buy more shares. So let's say if you have reinvested the dividends, then you have incremental increase on the shares bought. Every time it pays out the dividend, then you buy more shares. So you would actually own more shares over time, not just the same number of shares. Like over here is like same number of shares all the time. It remains at 3,307 shares. Well, so here, when you use the dividends and reinvested in it, then you get more shares. So you keep buying shares, more and more shares over time. And of course, that actually increases the dividend payouts based on the more increasing number of shares. So what happens here is that if you compare, if you compare here, this is not reinvested, the results, and this is the results that are reinvested, right? The dividends are reinvested, and of course, if you multiply the total, if you actually add this with the total capital gains, you get this, right? So that will be amounting to about 78% of the capital gain. So okay, let's look at another business which is J&J. So this is more consistent on the growth basis. So if we can see a straight line up here, but of course it's not growing more than 10% per year. There's no double digit on the growth there. But what we can see here is that it has very consistent cash flow and net income, right? So, and when we look at the dividends payout history, it also has been increasing over time. So of course, this dividend use would always fluctuate based on the share price that is changing. Right? So now let's look at the table right here. So let's say if we have invested about 100,000 and in about the year 2011, we could own around 1,525 shares. So of course, when we look at the capital gains, it's also giving quite a good capital gain if we compare this 10 years horizon. So we would have ended up with a capital gain of about 251,000 with just about 100,000 initial capital. All right, so that's about 151% gain. Now, how about the dividends? So the dividends in total, right here, it could give you about 46,000 on the gain, and which means about 47% of the initial capital. So not bad. So this is totally like a fixed income gain, right? And of course, if you actually add these two up, you would get about 298,000 of your total gains. So this is about 198% gains. Now, of course, this is not reinvested. If it is reinvested, then of course you get to buy more shares over time. And then what we can see right here is that the total gains would be about 205% compared to your initial capital. Now, the last one is that this is considered a high growth company, and it has also been in the industry for some time, so it's also paying out some dividends. So here are the fundamental characteristics. We can see that compared to AT&T, it's almost flat most of the time. Johnson & Johnson, it has moderate growth, and this guy has very high growth here. So what we can see is that also it has very high growth in the cash flow. And even well, for the past few years, it has also, the net income has been increasing over time. All right? So very consistent. Now we can also see that the dividends are also increasing over time on a year-on-year basis, even though the share price is also increasing quite a lot. So right here, you see, when the share price is going very high upwards here, you can see that the dividend yield starts to you will start to appear less. All right, from maybe here about the 2.8% down to even 1% right here, right, which is the recent dividend yield result. Now, let's look at the results that it could give you. So let's say if you have invested 100,000 in year 2011, right here, $28 per share, then you have ended up with about 222 per share, which is a total capital gain about 700%. All right, so this is like seven times added, or actually 8 times compared to this. So then the dividends would have yielded. Now this is even better than Johnson & Johnson. All right, so it would have given out about 51,000, slightly above Johnson & Johnson. Then the total gains, if you take these two together, and you will see about 744%. So what if you reinvested your dividends into the stock? And of course, so that's slight difference compared to this, all right, which amounts up to 56%. I mean 56,000. All right. So well, let's do a summary right here. Now, if we look at these three different companies, uh, my preference will always be I would like to stay invested in companies that still have very huge drive in the growth. So you can see that the AT&T share price is always stagnant, but it's paying you out a very high dividend. It's like it's not volatile, but it gives you a very stable income. All right. But Microsoft, of course, it's a little more volatile at times. You can see compared to the rest of these two companies. And but the thing is that it will give you higher growth compared to than these two companies. So now this table is a very self-explanatory. You can see that investing in high growth companies are always better than companies that give you high dividends payout. All right, so this is like a no-brainer here. So I hope you have enjoyed this video on sharing you what are the differences of the way, I mean, different methods to make money in the markets. And I hope you can start, looking for these kind of companies that fits your risk appetites in the market. And thank you for watching this video, and happy trading and investing. Signing out, Striker X here.